a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. The Fed stays put. Investors pare back rate expectations for cuts as Chair Powell stays on guard against inflation. A rush for deals and demands. The U.S. sets its tariff rate with South Korea and India on the eve of the August 1st deadline. And get ready for the busiest day of earnings this season. Apple and Amazon are on deck after blowout results from Meta and Microsoft. And it was those blowout results that are guiding futures higher this morning. Up 1% for the S&P. For the NASDAQ, it's more than 1.3%. You can see what happens when you don't have the big tech in the indexes. It's what the Russell is doing, down 0.1%. Yesterday, we declined into the close after that Powell decision where he was more hawkish. 2 days of declines. Again, we reversed that. Also, a lot of tariff headlines to deal with this morning, but that's not what we're trading on. For the bond market, it is a rebound after yesterday's decline. So we are looking at bond yields moving lower this morning. Yesterday, we saw two-year yields rise the most in 6 weeks with a Powell who didn't really incorporate those two dissents into his view. In fact, he was more hawkish to the point where he said, hey, you could argue we're looking through tariffs as one-off by not hiking. So that's where we're at. September odds of a rate cut go to 50-50. Let's get some moves underneath the surface, including some of those big tech names. With that is Valerie Teitel. Hey, Val.
Hey, Danny, let's start there with Meta and Microsoft out with some decent beats when it comes to revenue and some strong guidance from both of these names. Investors are viewing this extra CapEx spending they're talking about as worth it, given their core businesses are performing so well. Meta narrowed its CapEx guidance to the top end of the range, and Microsoft, the CFO, saying that the current quarter CapEx is running around $30 billion. Investors are still cheering all this extra CapEx spending. It's not just impacting these stocks, but the broader tech stocks today. I know you noted the move in the NASDAQ futures overnight, but take a look at Amazon and Nvidia. These stocks also getting a boost from this extra CapEx spending. Amazon up over 3%, Nvidia over 2%. And this is despite, Danny, this is despite China calling on some of the Nvidia CEO, Nvidia executives to explain some H20 chip security issues. So Nvidia rallying even with those negative news when it comes to China security. There is one stock that is sticking out like a sore thumb amidst all this tech optimism, and that is Qualcomm. Those shares are in the red so far this morning in the pre-market trade, down over 5%. Qualcomm is one of the main suppliers to Apple. It's highly leveraged to the smartphone market, which is still showing a sluggish turnaround. Danny.
Valerie, fantastic wrap up. We'll catch up with you later in the hour to see how those moves evolve. Also in this hour, in just moments, Jane Foley of Rabobank will be joining us on the dollar strength. Later this hour, Evercore's Julian Emanuel will be here with me as a guest host for the back half hour in New York around the desk. Back to the Fed, though, one of our top stories. Chair Powell bucks the pressure from President Trump and holds rates steady.
Despite elevated uncertainty, the economy is in a solid position. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get.
So you can see the hawkishness from Chair Powell there, and a combination of that, higher yields, a solid GDP print yesterday, sent the Bloomberg dollar spot to its highest level since May. Now the dollar is on course for its best week since 2022. Joining me now to discuss is Jane Foley, head of FX strategy at Rabobank. Jane, does this mean that there is a revival of U.S. exceptionalism, that the dollar is back in vogue and the weakening trend is broken?
Well, you know, it's really quite interesting because if we look at US equity markets since June, then we could be talking about that then. So, for instance, in the equity markets, you could say, well, look, this rotation trade away from US assets, which really characterized trading in the first 5 months of the year, it was over. And yet the dollar in June, and then actually beginning of July mostly was on the back foot. There was an attempt at a dollar revival at the beginning of July when that payrolls data came in firmer. But the dollar, I think, has been lagging this end of rotation trade. Stock markets really picked up a bid. The dollar didn't, perhaps because the market was anticipating a more dovish Fed. But I think we needed this washout in positioning. I think the market had become too long dollar at the start of the year. This rotation trade certainly caught up and characterized all US assets. But whereas the stock market began to recover, a month ago, more than a month ago, the dollar did not. And so I think this is what we've just seen this week, is this washout of positioning and this recognition that the US economy hasn't been as hard hit as we all thought it could be back in April.
Well, part of the trade, at least yesterday, Jane, was indeed a Powell who didn't even really lay out what the dovish conditions would be for them to be able to cut in September. We heard it there. He really just didn't even want to get into it. So it was a dollar that was driven by rates, by rate differentials. Jane, it's something we really haven't seen this year. It had been the rotation trade, the revival of Europe. Are rates back in the driver's seat? Is Fed policy back in the driver's seat for where dollar goes from here?
Well, if it is, then we could see, again, a weaker dollar in 2026, because, what happens come May when we get a different Fed chair? What if the Fed's Powell steps down from his role as governor? What if we get two new seats opening up on the board of the FOMC next year and a much more dovish committee? Now, if that is the case, then we can still be looking at a weaker dollar again next year. But I do think we also have to examine what's been going on the euro side of the euro-dollar equation, because I think really since March, we've seen a very strong performance of the euro. And I think we all recognize that that was very much a recognition of the change in Germany's debt brake, the expectation that would unleash a big round of growth, not just in Germany, but potentially in that whole European region. And I think what we've seen, perhaps on the back of the EU-US trade deal, is this dose of reality, this recognition that things are still going to be hard for a number of German exporters. Yes, now they've got these 15% tariffs on the US. They still have relatively high labor costs and energy costs and labor constraints in some instances too. And if they had a stronger euro, well, that's just another hurdle. So I think there's been a dose of reality. The growth in Germany this year is widely forecast to still be really very low. And some of that growth that should result from this stimulus may not really be reflected in the data till next year.
So it's pressure for both euro and the dollar. And Jane, you laid out there an argument of things bringing clarity for both the euro side and the dollar side next year. The dollar, of course, being a more dovish Fed chair that cuts and more dovish members on the committee. Jane, what about until then? What is your read on whether September we will get something of a cut? We've moved below 50-50 odds. It was a Powell who didn't want to get into it. If they need the data clarity in order to cut in September, will we really get that in time?
Well, we certainly perhaps be a little bit better informed when we see that payrolls data tomorrow, but also we need to see more inflation data. And I think what's going to be really pivotal on the argument as to whether or not the Fed can ease in September is whether or not there's more weight on the argument about whether the inflation impact of tariffs is going to be transient or not. And there's a number of economists who suggest, yes, it will be transient, it'll be a one-off impact, the Fed can look through that. And that argument certainly has been strengthened by the fact that the tariffs won't be as strong as we thought they could be in April. But on the other hand, there is still the risk that we could get secondary implications. And that, to some extent, depends on how tight the labor market is. If the labor market loosening, it doesn't really happen much. Then workers probably have a little more power to negotiate higher wages if their cost of living goes up. So there are still a number of factors up in the air, and we do need more data. But of course, you could argue that by September, we still won't be entirely sure whether or not that the inflation impact will be significant or transient from the tariffs.
What happens, though, Jane, with all of that, if you have tech companies spending tens of billions building out AI infrastructure? What does that do to a U.S. economy? What does that do to the Fed's ability to cut if there are pockets of weakness, but just incredible spending still ongoing from these companies?
Well, precisely. I think if we do get a lot of investment in the US, if we do get this capex, if we do get continued high productivity growth in the US, this all stands to show that the US economy is in really good shape. But of course, the more productivity growth we have, then you could argue, well, that means there's not going to be so much of an inflationary impact, and therefore the Fed could potentially still cut interest rates. So all of these things, all feed into what policymakers are thinking. And this is why they're always arguing that they are data dependent and they need to see more data before making those really important policy decisions.
So the cross currents and the muddle continues on. Jane, thank you so much for joining us this morning. Jane Foley of Rabobank. Now let's get you some other top stories that are trending on the terminal this morning. A Delta Airlines jet made an emergency landing in Minneapolis. It injured at least 24 people due to the severe turbulence. Delta Flight 56 was less than an hour into the 9-hour flight from Salt Lake City to Amsterdam when pilots met with challenging conditions, were forced to make that emergency landing, that according to a statement from Delta. The Bank of Japan's governor has cooled expectations of a near-term rate hike after deciding to hold rates steady. Kazuo Ueda said that the bank wasn't in danger of falling behind the curve on inflation, even after boosting its median inflation projection from 2.2% to 2.7%. And Russia has defied President Trump's push for peace with Ukraine by attacking Kyiv with a barrage of drones and missiles overnight. The bombardment lasted for several hours, killing at least 6 people, including a child, and injuring more than 50. All of that according to the Kyiv city military. Coming up on the show, more tariff surprises. Copper traders get a huge shock the day before the deadline. We'll show you the wild swings in the copper market and more on the tariffs. That's coming up on your brief.
Korea, as you know well, has always been very challenging on trade for the United States. We've had an agreement with them in past years, but our trade deficit with Korea has continued to be extensive. However, President Trump has raised the natural leverage of the U.S. market to really obtain some significant concessions from the Koreans.
Just a day away from President Trump's tariff deadline, the self-imposed one, and he announced the latest deal with Seoul on Truth Social, writing, quote, South Korea will be completely open to trade with the United States. We have agreed to a tariff for South Korea of 15%. America will not be charged a tariff. Joining us now is Bloomberg's Brendan Murray. Brendan, it was a lot more than South Korea, but let's just start there. And it's another 15% deal. Does this seem to be the floor barring the UK, but 15%? Is this likely what we're going to see for more countries as we move forward towards tomorrow's deadline?
Yeah, exactly. Somewhere between 15 and 20% looks like the new baseline across the world. It was very important for South Korea to get this deal done, given that it basically got the same agreement that Japan did, a big rival in autos and electronics and steel. So the fact that they could get this done before Friday means we provided some relief to South Korean officials who were facing higher tariffs and potentially a disadvantage against one of their chief rivals in Asia. So we're expecting another busy day at the White House today with more executive orders, perhaps more deals in the last few hours before the deadline. But it's definitely, we're starting to see how President Trump is reshaping the global trading system country by country and industry by industry.
Well, there's some of these tariffs that were reached by agreement, be it the EU or South Korea, Brendan. And then there are others that Trump just declared the rate. India is one of them, a 25% tariff. How much of a shock was it for the nation? And how have they responded thus far?
India was one of the countries that President Trump said early on were progressing well and toward a deal. That was a couple of months ago, but India has a reputation of being a very difficult trade negotiator, and that is proven to be what's played out in the talks with Washington this time. Now, President Trump says they'll continue to talk, so it's not as if that 25% tariff that India is getting is set in concrete. over the long term. So there could be more discussions heading into the months ahead for India to try to get that rate down. But in the meantime, yeah, it did come as a surprise that the president couldn't get that one over the line.
Brendan, just a minute here, but can we just take a bigger step back? A lot of these deals are being pushed through, again, with 24 hours to go until the deadline. How do we judge the quality of these deals, the meat of them, how much substance there is to them, and how much really more is going to need to be worked out throughout the remainder of the year and beyond?
Yeah, there's a lot of fine print we still need to see, and about whether these are actually legally binding, whether the commitments made. South Korea had another one of these investment funds like Japan did, whether they're actually realistic in terms of the size of the purchases that the countries are pledging to make. Remember, President Trump had a phase 1 trade deal in his first term, and that went nowhere after he left office. So whether these, are sort of the new paradigm of global trade, or just, deals written on a piece of paper that, don't have any lasting effect, is something we still have to wait for the fine print to understand.
And wait, we will. Brendan, thank you very much for that. Bloomberg's Brendan Murray will also catch up with you later in the hour. Now, the tariff surprises didn't just stop there. President Trump also slapped 50% tariffs on copper imports, but he exempted refined metals. You can see the huge plunge that had in U.S. traded copper, down 22% in the 2 days, about 20% just yesterday. Joining us now is Bloomberg's Martin Ritchie. Martin, how did this all unfold?
Well, as you said, this is another big surprise for the copper market after a year of big surprises and quite a lot of volatility. The copper tariffs have been signalled well in advance since at least February, but for a long time the kind of market expectation was for a 25% tariff. Then earlier this month, Trump, in off-the-cuff remarks, said it was going to be 50%. But very few other details were given. And even right up until, less than 24 hours ago, we didn't know what products were going to be covered. We didn't know if there were going to be any exemptions at all for any countries or producers. So when the proclamation finally comes out and it excludes what's called refined copper, the stuff that's really traded on the international exchanges, this comes as a major surprise. It was well short of expectations for what the tariffs would cover. Copper futures in New York went down by more than 20%. The prices went back into parity with the London Metal Exchange. A little bit of an earthquake in the copper market this morning after that announcement.
Martin, what is your understanding and why even have this exemption? Something that Trump, again, he had talked about copper, but never brought this up before.
Yeah, sure. It speaks to actually the kind of complexity and challenges involved in his campaign to bring back metals manufacturing to the US. Tariffs on steel and aluminum are one thing because the US has a substantial amount of supply of its own. Copper is something different. It's very dependent on imports. So to try and put in tariffs was always going to be a challenge, especially if you raise them up to 50%. So I think if you were going to be as generous as possible to the administration about the sort of delay and the last minute nature of this, it's like this is a very complex market to sort of work out what to do. And what they've done is they've put a stay on the tariffs on refined copper. Instead, there will be duties on more downstream products. That's like cables, wires, tubing and whatnot. And there will still be consideration of tariffs starting 2 years from now. So it looks like we'll be coming back to this subject, a year or two from now.
Well, hey, Martin, we will definitely have you on before a year or two from now. So much going on here. Martin, thank you so much for joining us. Martin Ritchie there. By the way, we'll be catching up with Julian and Emanuel shortly, who points to the decline in copper prices and its bleed through to other systematic and VAR-affected assets. But first, coming up, we're going to take a look at what else is making headlines in your front page news. That includes the easing of ties between the president and Jamie Dimon. That's coming up next. This is Bloomberg. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning. First up, the New York Times reporting that the White House has followed through on its threat to hit Brazil with a 50% tariff. The rate is the highest actually imposed by Trump this year and comes after the Times interview with President Lula, who struck a defiant tone in face of those levies. Next up, the Wall Street Journal reporting that Jamie Dimon and Donald Trump are talking again. The JP Morgan CEO has visited the White House twice in the past 2 months after a rift that lasted years. Last week, Dimon discussed the economy, trade, regulation with Trump. According to sources, Secretary Bessent and Lutnick were also at the meeting. Finally, you can read this on the Bloomberg terminal. China summoning NVIDIA over security of H20 chips just days after the latest talks with the U.S. concluded. Chinese authorities have asked the chip maker to provide documents relating to serious vulnerabilities just weeks after CEO Jensen Huang met with senior officials in Beijing. Coming up, more on the tariff impact and tech earnings. Julian and Emanuel will be joining us for the next half hour. Stay with us on your brief. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. The Fed stays put. Investors pare back rate cut expectations as Powell stays on guard against inflation. A rush for deals and demands. The U.S. sets its tariff rate with South Korea and India on the eve of the August 1st deadline. And get ready, the busiest day of earnings this season. Apple and Amazon on deck after blowout results from Meta and Microsoft. And that is what's guiding equity markets higher today. Yesterday it was about a hawkish tone from Powell that sent the S&P to its second consecutive days of declines. It looks like we'll reverse that today with the Nasdaq outperforming thanks to Meta and Microsoft and the tens of billions that they will be spending in capital expenditures. We also have to digest some tariff deadlines, some tariff headlines as well. But for now, it was Powell that seemed to be moving markets, at least bond markets yesterday, with the two-year yield hitting its highest level in a couple months. You see it reversing this morning, down about a basis point for the two-year yield. 10-year yield goes down a basis point as well. Let's get some stocks moving in the pre-market now. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with the big tech. Meta and Microsoft out with some decent beats when it came to revenue. Both of their core businesses holding up decently well, and investors are cheering the extra CapEx guidance on top of it, saying it is worth it given how well the core businesses are doing. For Meta, they revised their CapEx guidance for the full year to the top end of the range, and Microsoft, the CFO, saying the current quarter CapEx is running around $30 billion, a record for the company. If this isn't enough green on the screen for you, Danny, I have two more. One of them is eBay, a sales surge leading that stock to jump in the pre-market, up 13.5% for eBay. This comes also on the back of some optimistic guidance. They're seeing the consumer as resilient and maybe some consumer patterns changing, Danny. They're seeing a lot more consumers trade down to used and refurbished goods. Maybe that's a way that these consumers are navigating price increases or anticipated price increases from tariffs. Lastly, let's end on Carvana. A bit of the same theme here. The used car reseller seeing a record amount of used car sales in the previous quarter, 41% gain, and they're able to keep up inventory off the back of that. So those Carvana shares up some 16% in pre-market trade, putting those short sellers into doubt. Danny.
Valerie, thank you very much for that wrap up. Excellent work this morning. Now let's get back to one of our top stories. Washington and Seoul strike a deal.
Korea, as you know well, has always been very challenging on trade for the United States. We've had an agreement with them in past years, but our trade deficit with Korea has continued to be extensive. However, President Trump has raised the natural leverage of the U.S. market to really obtain some significant concessions from the Koreans.
The U.S. sets a 15% tariff on imports from South Korea, plus major investment in key American sectors. President Trump writing on Truth Social, quote, South Korea will give the United States $350 billion for investments owned and controlled by the U.S. Additionally, South Korea will purchase $100 billion of LNG or other energy products. Joining us now is Bloomberg's Brendan Murray, who's back with us. And Brendan, this also mirroring what we got from the EU of pledged investments there. Let's just talk about the investments for a moment. They are pledged investments. What is the likelihood that they come to fruition? How difficult will it be for nations to actually achieve this?
Yeah, so that $100 billion in LNG purchases by South Korea, for instance, isn't really much more than they already purchased. So I think the important thing to remember here is the net figure that's different from what they're already doing. The figure from the European Union was also in the hundreds of billions of dollars, and it looks unrealistic, their energy purchases, to even to have the capacity to purchase the kind of energy that they've agreed to purchase. So a lot of these deals are coming in with these big numbers, and they're impressive. And Trump could now say, it's in the trillions of dollars, the amount of money that's being pledged. But the real test of this and whether it leads to actual investment in the U.S. are going to take years to play out. And we're still on watch for more of these to come across today ahead of the deadline. So we're expecting another busy day of executive orders and other kinds of things coming from the White House.
I hope you had enough sleep in 2024 to carry you through to 2025, because obviously that's not happening anytime soon, Brendan. There are deals like that of South Korea that have been reached by agreements. And then there's other shockers. India, 25% tariff was a shock. All of a sudden, this change in copper, a 50% tariff, which he had hinted at, but a exemption for refined copper that sent prices plunging. Brendan, what is the difference and what is driving between nations and various sectors that get an agreement versus ones that get a surprise tariff rate?
Yeah, definitely. India is emerging as the biggest loser in Asia so far with that 25% tariff, and then the surprise from the copper tariffs is the kind of thing that we could see again today and going forward. President Trump made clear that things are coming out tomorrow. These tariff rates are going higher, but these discussions are going to continue on. He wants to further negotiate with India and see if they can reach some sort of better deal for both sides. But I think the bottom line is this patchwork of tariffs on countries and products that we're seeing being rolled out. It's going to be difficult to distill down what it actually means for the U.S. and global economies until we see it all on the table and it all gets implemented, which so far, we're not even at that stage. We're at the beginning of this rather than the end.
Brendan, thank you so much for this morning. I'm sure we'll talk again tomorrow. Bloomberg's Brendan Murray there. Now, Evercore's Julian Emanuel weighing in on the surprise on copper, that exemption, writing, quote, lifting the copper tariff caused a price plunge of 19% in minutes that quickly spread to other VAR-affected systematic trader instruments. These dislocations still leave us tactically cautious as asset price volatility in general is too cheap coming into the seasonally challenged August-September timeframe. He's Senior Managing Director of Equity Derivatives and Quantitative Strategy and joins me for the next half hour. Julian, thank you so much. Great to see you this morning.
Good morning.
This is really interesting. And by the way, I'm sure you're not sleeping either these days. So thank you especially for joining us early. This is really interesting because the price plunge in things like S&P futures, the euro dollar move also happened at the time of the Powell presser. Are you saying that some of the volatility caused by the surprise in copper was more of a driver yesterday?
Yeah, if you look at it, so the announcement around copper basically came out when the Fed's announcement was released prior to the Powell presser. So it started before 2:30. And really, the damage in the copper market was essentially over by the time Powell started talking. But what happens is in an environment like this, where volatility across assets has been squeezed so low, and rightly so, given the strength of the rebound off of the April lows. But there's been this sort of systematic feeding where position sizes have been getting bigger and bigger. And you get to a point where things get a little stretched, and obviously you have a dislocation like what you saw in copper, and it just quickly spread. It spread into the currency markets, it spread into Bitcoin, gold, and then ultimately again in the S&P 500. But that was addressed after the close when we got the AI results.
Right, exactly. This is the thing. It rebounds really steadily this morning because of the AI results. So if we're headed into a period of dislocation, more volatility, should you do anything about it if there are other factors in the economy and earnings that can just turn around and lift things right back up?
Well, and it's funny because investors tend to believe that when the markets are trading as well as they are, that it's an easy time to invest. In a lot of ways, it's much more difficult because valuations are high, volatility is low, and we know that's not sustainable particularly coming into August and September. We always know September is challenging. Essentially, our view is you sort of stay with the AI theme. It's worked. Obviously, it's working this morning. It's going to continue to work. But owning some protection beneath is really wise, particularly when you think about it in the backdrop of how much these names have already outperformed.
Well, the interesting thing is that for the most part, people are really just shrugging off the tariff impact, at least for now until it shows up in the data. So until it shows up in the data, is this the risk that we could get more announcements that dislocate things?
And let's remember, tomorrow is August 1st. I don't know how we got there already.
I don't either, Julian.
but you know, China is still an issue. We don't even know if the can is getting kicked. That still has yet to be announced. And then, of course, Canada and Mexico, and you put them all together, that's over 40% of imports into the U.S. That's still an open question. And from our mind, a lot of the valuation drift higher this summer has been a function, to your point, of the fact that investors don't believe, because they haven't seen the tariff impact hit yet, they're discounting that they'll actually see it. You know, our economics team does believe that you're going to see it in terms of a bit moderate growth and, you know, inflation really remaining firm the next number of quarters.
But when does that show up? I guess what's the order of things? Can you continue to hit record after record throughout the entirety of this year, or do you start to see things show up in the second half that really challenges that?
Well, again, I think it's a seasonality thing, it's a valuation thing, and then, of course, part of the narrative has been because the tariff collections have actually been lower than expected because a lot of goods were exempt, a lot of goods were on the water, but that's sort of all fading away. So in our mind, the challenge will come with the expectation that the data will turn, call it September, October.
How important is it for this equity market that we get Fed rate cuts this year?
Look, September, I have my dollar coin. It's a coin flip, okay? And the thing about the bull market over the last couple of years is that it's been able to shrug off, you know, the Fed's cutting, the Fed's not cutting. The biggest point in momentum-driven bull markets is not whether the Fed's cutting, but the fact that there's under no circumstances is the Fed going to get tighter whatsoever. That's really the important thing, and that lets the fundamentals fully express themselves. We think it's a 50-50, but clearly when you look out to the end of 2026, the expectation is that we are going to resume this cutting regime.
All right, well, I'm looking forward to tossing some more coins. Julian, stick with us. That is Julian Emanuel, who will be with us throughout the rest of the show. First, though, let's get you some other top stories that are trending on the terminal this morning. A Delta Airlines jet made an emergency landing in Minneapolis. It injured at least 24 people due to that severe turbulence. Delta Flight 56 was less than an hour into the 9-hour flight from Salt Lake City to Amsterdam when pilots met with challenging conditions, had to make that emergency landing, that according to a statement from Delta. The Bank of Japan's governor has cooled expectations of a near-term rate hike after deciding to hold rates steady. Kazuo Ueda said that the bank wasn't in danger of falling behind the curve on inflation, even after boosting its median inflation projection from 2.2% to 2.7%. And Standard Chartered CEO Bill Winter says that he still doesn't see the need to force his senior bankers to be in the office more. He told Bloomberg, quote, "We work with adults." Winter has maintained a high degree of flexibility at his bank, even as others like HSBC and JP Morgan have cracked down on hybrid work arrangements. They surely must be one of the last to allow that. Coming up, blowout earnings from Meta and Microsoft, Apple and Amazon on deck. We're going to look at big tech's performance. That's coming up next on your brief.
To build this future, we've established Meta Superintelligence Labs, which includes our foundations, product, and fair teams, as well as a new lab that is focused on developing the next generation of our models. We're making good progress towards Llama 4.1 and 4.2, and in parallel, we are also working on our next generation of models that will push the frontier in the next year or so.
Meta and Microsoft results driving futures higher in the pre-market trade. Microsoft is set to hit $4 trillion in market cap with that 8.3% rally. Meta up nearly 12% in the pre-market. Let's get into the numbers. Joining us is Mandeep Singh, senior tech analyst for Bloomberg Intelligence, and Evercore's Julian. Emanuel is still with us. Mandeep, some huge numbers being put up by these tech players.
Yeah, look, I mean, in the case of Microsoft, I think we saw a 500 basis point sequential increase in their Azure growth. And when you look at Google, they also had a very similar increase. And in the case of Microsoft, clearly, they are taking share when it comes to the overall cloud and AI pie combined. And, when you are compounding the business at 40%, and you have got a backlog of over 300 billion, it gives you a lot of visibility to the run rate and how this business may look 2 years from now. In the case of Meta, I would say clearly the ad recommendation engine is working very well. AI is helping that. But in terms of visibility, yes, we are talking about superintelligence labs and what they are doing. They still don't have the kind of frontier model adoption that we have seen from ChatGPT and Anthropic. And that is where I feel from a visibility standpoint, Microsoft is far better. It reflected in their numbers compared to Meta. But again, nothing to take away from the fact that the quarter was great for Meta. Probably the TikTok ban, the potential ban is helping them capture more video ad share. And there is potential in WhatsApp monetization, but I still feel Microsoft visibility is far better.
So, Mandeep, you talked about the adoption, and curious, what's the commentary around how the depth and breadth of customers across industries have begun to use the product and really engage in recent quarters?
Yeah, I mean, Microsoft called out that coding agent use case, which is reflected in their GitHub Copilot adoption. They are seeing that, in other types of products. So that's where they're end-to-end. They provide the AI infrastructure, but they also have applications that are, showing the adoption. In the case of Meta, it's a big bet. I mean, they're talking about $100 billion in CapEx spend. OpEx spend is going to grow 25%. I would be very skeptical about margins expanding from here on, especially for 2026. Again, 20% growth on the top line is great for margins, and for their core business, the incremental margins are very solid. But for the spend that they are doing on AI, they don't have an established use case. The one promising use case is WhatsApp's use in customer service. That's where they could get a lot of momentum. But for that, they need a model that's comparable to OpenAI and Anthropic and Gemini. And right now, they're more in fixing mode in terms of getting the model to where the frontier models are.
And when you think about CapEx in general, when we came in to 2025, the expectation was that you were going to reach sort of the peak of the CapEx cycle in terms of AI, call it the first quarter or the first half of 2026. Where does that stand now?
So Microsoft yesterday told us that they will likely be supply constrained through the first half 26. And to my mind, if Microsoft, the biggest player in terms of inferencing, is telling us they're supply constrained, that really bodes well for CapEx investment. And Meta talked about, over $100 billion in CapEx for next year. So the CapEx numbers look really promising, and we know inferencing demand has been aided by these reasoning models and test time compute. So from that perspective, I do think we are good, at least for the first half of 2026.
Hey, Mandeep, just quickly before we let you go, Apple and Amazon today, what are the expectations?
So we saw Qualcomm print was okay in terms of handset revenue. So there is no big refresh cycle looming on the horizon for Apple, and plus tariffs. The India tariffs would likely be a bigger drag compared to the guidance, the 800-900 billion guidance they have given. And for Amazon, look, they need that 400 to 500 basis point sequential increase in AWS, similar to what we have seen from Microsoft. and Google Cloud. So the bar is high. They need to show that AWS is neck and neck when it comes to cloud compared to the other two hyperscalers.
Mandeep, thank you very much. We'll see what those earnings bring. Mandeep Singh of Bloomberg Intelligence. And Julian, I love that question you asked Mandeep about adoption. How much is that guiding you when you look beyond the hyperscalers? How important is that to see other companies start to use some of these AI tools and find a use case for it that can increase productivity?
Well, it's really the whole ball game. Look, we've known, and the hyperscalers have been aggressive for going on 2 years now. They spotted the opportunity. Clearly, every roadblock that would suggest that CapEx would come in has been surmounted because there is growth and there's expectation. But the key as to why the AI theme has worked as well as it has this year is because whether it's industrial automation or whether it's, customer service or back office functions, it is really being adopted by the entirety of corporate America. And the modeling that we did when we launched on AI 2 years ago said that corporate America would be at 25% adoption rate by the end of 2025. We're right on target.
The interesting thing, though, is there was a point, Julian, where people didn't want to own Microsoft because of the capital intensity story, and that people liked companies like Meta, like Alphabet, because they were capital light. That has obviously changed. Should we also be re-examining these companies and the types of valuations that we give them if their business model is now different?
It is. That's a great question, and I think that is part of the sort of the psychological evolution with respect to the fact that, I think there's no way of getting around it. Technology has become an ever more increasingly important part of the economy and clearly part of the market capitalization. There will come a time, and which is why I asked Mandeep about the extent of the CapEx cycle, where we will question that. But at this point, that seems further off in the future.
Well, as we were talking about before the commercial break, that you're a little bit nervous because of some of the valuations. But long term, as long as these companies are spending, as long as there's AI, can you bet against this equity market?
It's very difficult to do it. And in fact, as a long-term investor, you shouldn't do it. OK, it's prudent to hedge every once in a while. It's prudent to move sort of your cash allocations around a little bit. But for us, the meat of the returns are where we've been the last couple of years. And it is, and we see it on the screen this morning, it is in the AI theme.
Well, lucky for us, we have more AI earnings to get through. Julian, I just want to go through the calendar of what we're going to get today really quickly. A look at what's ahead. Before the bell, we're going to get earnings from MasterCard, Norwegian Cruise Lines, among others. 8:30 a.m. Eastern, we're going to get U.S. PCE and personal income and spending data. And then it's more earnings. Apple, Amazon are due after the market close. Julian, when you look at drivers for the rest of the week, so we have all of that. You also have jobs data on Friday, too. What to you is going to be the most important driver? And again, we also might get more trade announcements coming up ahead of tomorrow's deadline.
I would suggest that, again, the Mag 7 reporting this evening, the bar has been set very, very high based on what we're seeing this morning. In our mind, it's probably going to be the trade announcements. If Canada or Mexico or China sort of gets tweaked contra to expectations, although there is a suggestion that Canada may be made an example, that's going to be a reminder that, risk and volatility is perhaps a little bit underappreciated.
What's your understanding then of how sensitive this equity market is to economic data? Is it not very, if maybe jobs is less important tomorrow?
Well, here's the issue, okay? And Powell pointed this out yesterday. When supply and demand of labor is both decreasing, it's much more difficult to handicap what the effect of a number is. So if you recall, you had the ADP data the prior month was negative. It was, there was a flawed data series, not correct. But the fact is that given what's happened with immigration, the sort of the bogey for the monthly jobs ad is closer to 100,000 than perhaps when it was a year and a half ago at 150,000. But we're still trying to parse through the cumulative effects of immigration, of tariffs, of stickier inflation.
All right, Julian, we're going to have to end it there. Thank you so much for joining this half hour. It was really wonderful to see you this morning. So many interesting things to cover. That is Julian Emanuel of Evercore ISI. All right, let's quickly get a market check as we head to the end of the hour. It is an S&P 500 session that continues to move higher this morning, up about 1%. It is an outperformance from the NASDAQ thanks to some of those tech earnings. Bloomberg Dollar Spot continues higher after trading at its highest level, or at least is on track for its best week since 2022 after that Fed decision. Your 10-year yield that's down by 1.5 basis points after yesterday, a 2-year yield that moved higher thanks again to some of the more hawkishness, shall we say, from Powell. Let's quickly look at some of the companies moving the pre-market too. Qualcomm, they are the lone tech player that's down nearly 6% this morning. A lackluster growth with concerns that tariffs will take a toll. Lam Research down 6% despite a beat in forecast. Finally, Amazon, strong results from Meta and Microsoft lift shares ahead of earnings. Again, Amazon and Apple will be reporting after the bell. That's it for Bloomberg Brief this morning. Surveillance will take it from here. You're watching Bloomberg TV.